Hey everyone. So I wanted to talk about how I first got into investing. So I started in the stock market. I was about 18 to 19 years old, and my best friend came to me and was trading on Robinhood. So I saw that he was trading penny stocks, and I just got my first job. I've been saving a lot of money. I had maybe $5,000 or $6,000, and I decided that I was going to invest about 1,000 into the stock market. With that 1,000, I felt really confident because I was not investing in pennies. Instead, I was going to invest in some more bigger companies, and those bigger companies consisted of $10 to $200, right? So I bought stuff like Facebook, I bought stuff like Ford, I bought a couple of companies that I would never really hold in my portfolio today. But what it showed me was I could have a piece of something. So when I bought McDonald's and I walked into McDonald's, I felt a little bit better. I felt like they should all know my name. They should all know that I'm invested in McDonald's. They should give me free food because I'm keeping this company afloat, right? All good and well. I'm sure everybody felt like that when they first started investing. But over the years, after day trading, swing trading, and I was really making a profit off of swing trading and day trading, because when you analyze a company for days, you get to see the trends within that company. So Ford would always stay around $10 to $11.25. So every time it hit $10, I'd buy in, and when it gets to like $10.50, I'd sell. And I did that for some time, and you could make about $200 off of $1,000 in 1 year. So that was about a 20% spread. To me, it didn't seem like a lot for the money that I put in. However, it was a gain, and each and every year for the first 2 years that I day traded, I gained. But then I would look at my yearly and I would see, okay, I only made 200. I only made 200. And then I continued to look at other strategies. I did options trading, and I made 700 in a day. I've lost even more in a day. And I don't think option trading is investing. I think that's gambling, and I would definitely advise against that. But for the purpose of this video, I'm just stating what I went through. I'm not your financial advisor. And so over some time, I realized that I didn't necessarily want companies that just grew, although they grew fast. Although I see the owner of the Clippers, who invested all his money in Amazon, is now a multi-billionaire. I wanted something that I would never have to sell my assets in order to live off of it. And in order to do that, I needed to go the dividend investing route. And especially when you don't have a lot of income and you want to diversify into other stocks, I believe that this is the best strategy, because you're now using your dividend investments to now diversify into other companies without having to sell any companies. This is the best strategy in terms of diversification in the stock market, in my opinion, because this allows you to keep all your stocks without having to sell off any of the shares. Now, in terms of making a lot of money a lot quicker, the fast way, but also the most secure way within the stock market, I do believe that growth stocks would still be the better option. So someone said to me, hey, I'm looking to invest. However, I probably need this money in the next 2 to 3 years in order to purchase a property or invest in something else. Then I would say it's probably better to go with a blue chip growth stock investment that is probably down, and that you've done your research on, and that seems to have some value to add or be added. That is definitely going to give you a better return, as long as you've done your research on the company, as long as you've checked your boxes. that will probably be the best option and strategy for you at that point in time. I've also seen people invest in the highest dividend stocks that they can find, 10%, 11% dividend drips and things like that going into their portfolio. And to me, I always saw that as a sinking ship because there's no growth in those stock companies. They're only staying afloat because of the dividend itself and not because of the company and what the company stands for. I know a lot of rookie investors that invest in these companies just because their dividend is so high, 5, 6, 7%, but not because of what the company actually does or anything like that. And so you can find yourself making the same amount of money throughout the entirety of the year because the stock went down a little bit, but the dividend stayed the same or went up a little bit. And so that's why I invest in dividend stocks that actually grow the stock as well as the dividend over a long period of time. That gives me growth as well as dividend growth. And it also allows me to compound that interest rather than having to watch my back on whether my entirety of my portfolio falls due to the stock going down, even though the dividend is paying out. And so that's just my take on how I invest in dividends. So I look for bigger name companies that do grow their dividend, but also the company is growing as well by 11% or more each year. And that shows me that this is a company worth looking into, worth investing in, even though the dividend might be 2 or 3%. So that's just my take on it. Why I became a dividend investor. I'll talk more on why I don't day trade. So day trading took a lot more of my time and effort. What day trading is just you get a stock and you trade it that same day. So it might be a little bit more volatile. There may have been some news that came out on it. And you might take a $10 stock and sell it for $10.20. And then when the stock goes down to $10 again, you buy it and then you sell it again for $10.20 when it goes back up. Then it goes back down, you buy it, and then you sell it for $10.20 again when it goes back up. That day, you've made 60 cents off of the same $10. And you can realize that as a profit to yourself. Now, of course, that comes with the highest taxes because it has not matured. I'm at a loss for words for what that actual term is at this point, but the taxes are higher because that investment hasn't matured for over at least a year. But this is the way that I used to make money on better known companies that I've studied for years. I would just have like 5 companies in my portfolio and I would watch them every single day. I would look at the numbers that they were at. I basically knew their floor just by eyeing it and understanding where they were the last 52 weeks, where they have been, what months they do better than other months. And this allowed me to continuously make a profit. Is an investment strategy because if you know what you're doing, it's going to work. The only risk is that certain times, for example, Elon Musk buying Twitter, that can have a negative impact on Tesla, although it is of no direct correlation. Him putting all his money into Twitter takes away from him putting money into Tesla and growing that company to more profitability and making more factories and things of that nature. $42 billion could have opened up another Tesla factory site and allowed for more growth opportunity and more Teslas to hit the market, more job opportunities, and more EVs to saturate the market a little bit more, which would allow for more profit as well for the company as a whole. So that can have effect on how Tesla does in the short term rather than the long term, because in the long term, we know that Tesla is still going to be all right. However, if you're a day trader, that can have a negative effect if you thought the stock was about to go up and then you buy at the height of it and then it starts to go down. So that's another thing to take into account. If you have someone in charge of a company who is more front facing and is always going to be in the limelight, that can definitely impact the stock a lot more than a company that's been around 20, 30, 40 years and is very, very much more consistent. So that's all I have for you today. Hope you enjoyed this video, and I'll see you on the next one. Peace.